In July report, you said that banking regulations might have consequences for rate policy going forward. Now we have the Basel III proposal. Have you factored that into your rate forecast?
No, not yet. It's too early to tell what's going to come out of the Basel III process. I mean, negotiations are still going on. And what's clear so far is that it will take many years, actually, before Basel III fully applies. And also, which is quite interesting, is that the Basel Committee and the Financial Stability Forum in the course of the summer produced a number of reports where they have tried to calculate the consequences of these proposals using a model framework which is fairly close to what we use when we do our projections. And what they conclude, if one reads all that stuff, and it's a lot, is that basically, if you translate these rule changes into spread calculations, into interest margins in one form or the other, they conclude that this doesn't produce very marked shifts in interest margins. So far, as far as we can judge, it looks very, very manageable. What they also conclude, and one can argue about how you actually do these things, is that they sort of conclude that if you implement these rules, that also reduces the likelihood of future problems. And by reducing the likelihood of future problems, you actually reduce volatility, let's say volatility in GDP terms. And that's a good thing as such. So net, they argue, and they actually argue quite strongly, net, this is really beneficial for society as a whole and quite manageable in the short run. But to move from sort of those calculations that they have done for many, many countries to a state when you actually can plug that into, let's say, what you have behind me here on the screen, weren't there yet. I mean, there's plenty of work to do when it comes to doing that. But we don't think, as far as we can judge right now, any sort of major surprises in that would sort of completely change the way one looks at monetary policy and interest rate paths and interest rate margins and all the rest of it.
So it's less likely to affect rate policy than it was before this proposal?
Well, in the early days, no one really knew which way this was going to go. And there's been all sorts of views and speculations on how this actually works and how it will operate and how much it will do to interest rate margins. What one needs to be mindful of, and this is sort of a bit kind of, is that in the papers that were published in early August, the assumptions are quite conservative. So all the assumptions there assume that whatever increased capital requirements, increased liquidity demands that you have, and so on, is eventually ultimately passed on to the customers. That's a very conservative assumption, because also what happens, and one would really need to have a financial sector general equilibrium model, kind of a sectoral general equilibrium model, and we don't have that. Because if you were to have that, then it's more likely that you get even less effects coming out of this in terms of increased interest rate margins. Because if banks become less risky, it doesn't seem reasonable to assume that the return on equity should stay the same. Because then something does not quite add up. And that means that in terms of when you put these rules in place, part of the cost of that rule will be absorbed, or is going to be absorbed in one way or the other by the shareholders. But how much of it, what the incidence, if I call it that, is going to be, and what the distribution of the incidence is going to be, between different liability holders. If you look at the balance sheet of of the banking sector or individual banks, that's way too early to tell. But in the August papers, what they do is they do it in a quite conservative way, and still they come up with conclusions saying that this is sort of manageable in terms of in interest rate margin terms. There's no major drama in this, and if you add adjustment periods of, I don't know, 5 to 10 years, then if we're talking about it in this particular time frame that we're talking about it here today, then it's just not meaningful to pin down numbers for that.
Can I just add a very narrow dimension to this debate? I mean, to the extent that things like this are factored into actual behavior in the financial market today, say prices or whatever it is, then to some extent we do condition on it, because we actually condition on, actual bank rates and things like this. But it's hard sort of to identify what that would be and how much that would be. But I guess the uncertainty around these things are enormous, and the estimates of the effects are all over the place, so it's difficult to know.
Okay, if there are no questions, the topic has been exhausted for today. I really invite you to continue discussing the issues that Per raised about future rates and what you get out of it or what you don't get out of it. Because
sorry, it's too late to...
Hello.
Sorry to interrupt. Is it too late to ask a question from the phone? It's a bit lagged here. So I've had a bit problems with hearing. So
No, not at all. Please go ahead. Go ahead.
Thank you. I'm calling from Nomura. I just had a question on whether you have any thoughts as regards the September elections. I assume there's too much uncertainty for you to actually have incorporated it in your current forecast. But have you got any thoughts whether it's likely to affect your domestic forecast, whether or not the alliance stays in power?
No, we don't do election forecasts that we then sort of factor into our own forecasts, and we don't have a reason. We don't have reasons to do that, because what we have in our forecast is a forecast of what fiscal policy is going to look like over the coming years, and the fiscal situation is very stable. And the judgment that we pass is that regardless of the outcome of the election, it's going to stay that way, and that's what we do. So this is not, given the state of the Swedish economy, an issue. So we haven't really included that at all, more than in the way that I just said, and that's because we don't find a reason to do so. Hello.
Hi. Hello. Can I ask another question as well?
Sure.
Hi, this is Calvin C. from Morgan Stanley. I was just wondering, for your monetary policy forecast, is there any sort of sensitivity to the Swedish krona that you have built in there? And I was just wondering what sort of levels of the exchange rate have you incorporated into your forecast?
Yeah, I mean, we've been revising the path for the krona slightly compared to July. So the krona is appreciating a bit quicker than it did in July. But it's not a dramatic thing. I think for one thing is a marginal adjustment due to actually outcomes, just simply. And then since the growth difference is a bit enhanced between Sweden and other countries, that also contributes to a stronger path for the krona ahead.
A very simple answer is to say that it's the way it usually is. Our projection says that the krona is supposed to increase.
One other question. You had mentioned today downside risks, probably stemming from weaker U.S. or European growth outlook. What sort of upside risks would you identify to the global economy or for the Swedish economy?
Well, one upside risk that I've talked about earlier today is if the wage outcomes down the road end up being different compared to what we have assumed. Because wages were set in a completely different state of the world compared to what we know, compared to where we're heading now. I'm not at all saying that it's going to happen that way, but that's one risk.
If there is room for one more question from Ilva again. I heard someone asking again, couldn't hear properly what was said about how market expectations are below your rate path. In terms of what to do about that, if that was to sort of remain something that was a concern for you, would you at all consider other methods than the actual rate, say for instance, selling bonds or something completely different?
Just off the cuff, I'd say that's very unlikely. Because our intention for quite a while now has been to make sure that we do the exit from other measures in an orderly way and in such a way that the market participants can fully understand what's going on and adjust to that. And we are quite happy with the way things have been going, and that we just have one more fixed rate loan expiring in October. And that means that in terms of the monetary policy framework and how we execute monetary policy in the daily running of the business, then that means that we are back to the framework that we have used for the past 15 years or so. And everybody in the Swedish market is very, very familiar with how that works and what it produces and what the various participants are expected to do and how the whole system is put together. And having achieved that, then to sort of move back to something that hasn't been tried before spontaneously, I'd say, is very unlikely. But that's just my view here. Okay, if there aren't any more questions in the room nor from wherever in the world you happen to be, thank you for coming.